Today, we're going to speak to a partner of Earlybird in Berlin, 2 billion assets under management, around 600 million euros of dry powder, is making investments at the rate of two a month and had 9, I think, successful exits last year. So a very warm welcome to you, Christian Nagel.
Yeah, thank you very much, David. Happy to be here.
Shall we talk a little about Earlybird? Can you just give us a quick summary of it?
Yeah, sure. We indeed in the business for quite some time, 26 years now, a really long period of time. It was a time where there was hardly any venture around in Europe. There were some UK, France, but not so much in Germany. We started in Germany. Fast forward now, we became one of the largest European players, I would say, with, as the name indicates, investing in early stage. So that's really our focus and has remained the focus and will stay the focus. We also have growth funds to support the companies in later stages, but the focus is really on early stage. And there's hardly any too early for us. So we invest also in seed, even pre-seed, whatever you call it. So we really cover the whole range in the end, but the focus is really on the very early stages. And we like tech. We're really obsessed about tech. Doesn't mean we are generalists, we are specialists, basically. The 3 main sectors we cover are fintech insurance tech, that's one of the bigger ones, including Web3, enterprise productivity software, that's another big sector. Companies like Rightpath fit into this sector. And the third sector, it's this buzzword, deep tech, but within deep tech we do space, we do energy, and we do food.
You're primarily investing in Europe. Where do you think are the exciting sectors for European entrepreneurs?
Everything which is labeled AI is very hot, obviously. Also, deep tech becomes more popular. Also, we basically changed our habit. You would have asked me 5 years ago, would we ever consider investing in hardware? I would have said no, never, ever. This has changed dramatically, to be honest. So we have recently also done quite some investments where hardware plays a role, where hardware is essential also. That has reasons because technology has evolved quite a bit. The next levels can only be reached by hardware.
Let's come back to your interest in being an early investor. You've now got very substantial funds under management. You're a very large, well-established venture firm with a big footprint. Does it become harder as you become bigger to invest in these smaller companies? Because the amount that you're investing at these early stages is going to be really quite small in relationship to the total fund size.
Yeah, that's a very good point. That's why we, for instance, did not scale our early stage funds to a large extent. The early stage fund, they're in the range of 300 to 400 million, which is a good size for Europe. It's more compared to the US, where you have early stage funds in billions. So we believe we're still in a size where every single investment matters, where every single investment we can become active with the team we have a board seat, and we can at least be active and support the companies. The growth on our side comes more through the later stage funds. So in terms of can we support the companies in later stage? Can we be still an investor in Series C, D, whatever? That's where basically the more money on the management, so to say, comes from and really deployed. Not so much in terms of the early stage, because we like to maintain the size to be able to have credible and good discussion within our investment committees. We have a little bit different process for those smaller type of investments we do, but in the end, in terms of support of the company, it will be the same. We have enough capacity to support those companies. It's not a spray and pray approach we pursue.
Not a spray and pray, yeah, fair enough. But
yeah.
If you invest, a few $100,000 in a promising early stage company, and that company in fact takes off and develop traction, are you able to use other funds, the later stage funds, to invest? Is cross-investing across your different funds allowed or not allowed?
We have a structure basically where we have one fund, which I mentioned, in the size of 300 to 400 million in each fund generation. We are just about to raise the number 8. And we have growth funds, and they do cross in the end. They only do basically later stage investments. So it's you could call it cross, but in the end, the purpose of those funds is basically to support companies which have been outgrown, so to say, the phase of the early stage funds.
You mentioned that it's a challenging time for early stage ventures now as money has become more expensive. Cost of money has gone up, but also the valuations of growth companies have come down. So you're kind of being squeezed a bit. How do you see that playing out in the companies that you're looking at the moment in terms of potentially investing?
The early stage companies which are raising now, they are aware, the entrepreneurs, they are aware of the fact that money has become more and more expensive. So I think the more cautious in spending, they more realize that it's not so easy to get to the next round. To build a company, certain money is required. And whereas company has been raising 2 years ago, let's say 3 million for first round, covering 1 year. Now they say maybe we ought to get there with 1.5 or 2 million, but we like to cover 2 years because it takes more time to raise, and we also don't want to raise ideally this year. So that's why on the C early stage, not so much has happened. The other decisive factor is the valuation, and good entrepreneurs, they accept the dilution of 20-25%, but they don't accept the dilution of 35%, which would basically mean lower valuation. So it's also another fact which hasn't changed. So that's why we see on the early stage not too much of a change, rather a more healthy, I would say, development in that regard, that the entrepreneurs are more cautious. They are aware of the fact that money has become more expensive, and they are aware of the fact that it's not so easy to raise. So I would say it's more healthy trend. On the later stage, yes, there we see this, and we're not so much actively investing in later stage and focus is really early stage, but we see this obviously in follow-on rounds in our portfolio, where you would have seen a doubling or tripling of valuations basically every at least a year, if not faster. That's not going to happen anymore. So we see companies raising on the same valuation like 2 years ago, which is already good, which is a huge success. Something, by the way, we also see in terms of the valuations which have been very high 2 years ago, companies maybe not needing in need of cash, they have grown into these valuations. So companies which have been valued factor 40, 50 on ARR 2 years ago, if they grow by 100% every year, now they are valued 10x, 15x, which is a quite healthy metric already.
Yeah. So you're seeing it primarily as an adjustment in valuations rather than just becoming harder to raise money. You know, you've got to be an exceptional firm to be able to raise the next round.
Yeah, that's also true. Obviously, the hurdle is much higher. That goes basically for all stages. Even good companies have not so easy to raise in those times. I'm talking about 23. Maybe this is going to change a bit in 24. At least everybody thinks so, that it's going to happen. And it's a little bit self-fulfilling prophecy. Wherever I've been in Q4 last year, everybody's talking about, yes, 24 should be better. Maybe not Q1, but Q4, Q2, or it should become much better. If everybody think alike, then it's probably also going to happen. Since we still have the fact, and this is maybe also different from other cycles, since we have the fact that the funds are on a very high fill level in the end. So there's lots of money to spend, since there hasn't been much deployed in 23 and in 22. And there still have been lots of funds being raised also in those time frames. So that's why less than years before, but still, and not much is spent. So if you look at Earlybird, we raised more money than we spent last year. And there are also good companies out there. So it's also another fact, very different from previous cycles. And we have new technology, we have AI, so lots of things happening in the deep tech sector. So they're very attractive and good businesses out there, which I think will also get funding.
If I were to play back to what you've just said, if you put together the combination of we are in a more normal cost of capital situation, there are excellent companies and startups out there, and there's still lots of technology and lots of opportunity, and venture firms have lots of dry powder. Can I take from that you're optimistic about the future?
Yeah, I mean, as a VC, you have to be optimistic because you have to look through cycles. Because we have been seeing cycles, we know that in cycles, the time you can't exit companies in down cycles, and you have to use the up cycles. And I'm very sure we will see valuations we have seen in the past again. Maybe not this year, maybe not next year, but we will see them. Technology is always evolving and developing further, and there will always be opportunities for venture. You have to adapt, basically. You also have to, with the terms of your investment strategy, you also have to adapt. has to basically add new sectors, has add new subsectors, leave subsectors, close sectors, and develop new ones. I think this is constantly involvement also on our side, but in the end, we are living from entrepreneurs out there, and in down cycles, this has been also proven in the past. In down cycles, great companies have been created. In every of these cycles, obviously, we don't know yet which one has been created this cycle, but looking back at other cycles, there always have been good companies created in those cycles.
Well, down cycles are a good time to invest rather than to exit.
Yeah, absolutely. Well,
Christian, thank you so much for your time and insight today. It's been very helpful.
thank you. Thanks, David. Thanks for being here.